Hi, this is Doug Skinner from AFS. I appreciate you watching this short video. The contraction in commercial lending continues for the banking industry. Now, this week, we got an update from the Federal Reserve on their senior loan officer survey. So we'll talk about what was in that and what the outlook is. And we'll also touch on what the banks are doing with their capital if they're not lending it out at normal levels. The pullback in commercial lending continues, particularly among the largest banks in the industry. You can see from this slide that C&I loan growth has actually been negative for several months of this year. Commercial real estate growth had proved to be a bright spot for the first half of the year, but now even growth for that segment has fallen off significantly. There are several reasons for this pullback. First, banks have tightened commercial underwriting standards significantly this year, which means they are being far more selective in terms of the customers they want to bank. They are tightening because they're concerned about the weakening economy, despite the fact that it continues to perform quite well overall. Now, the regional bank crisis we experienced in the spring didn't help matters and contributed to many banks becoming even more risk averse. Second, banks have been experiencing declining deposit balances for much of the year and have had to rely much more on expensive wholesale sources of funding than they have for in quite some time. Deposits are a cheaper, more preferred way to fund loans, so stabilizing core deposit levels is critical to getting back to growing loan portfolios. And third, the large banks in particular are bracing for higher regulatory capital requirements. The regulators have issued a proposal, what's referred to in the industry as the Basel III Endgame, which by some estimates would increase large bank capital requirements by an average of 16%. Certainly, a decline in demand for credit is also a factor, as a much higher interest rate environment is going to cool lending as well. So collectively, this has kind of created a perfect storm of headwinds that has held back commercial lending for the majority of the year. So this survey is called the Senior Loan Officer Survey on Bank Lending Practices. The Fed updates it every quarter, and it's designed to measure changes in lending terms as well as demand for business credit. And what the most recent survey showed is lending conditions remain very weak. It's been 6 consecutive quarters now where more banks were tightening underwriting standards on C&I loans to large and middle market firms than were loosening them. The demand side of things doesn't look much better. We've had 5 consecutive quarters there where lenders are reporting weaker demand for business credit. If you look at the history of this survey, every time we've seen both supply and demand for credit this far into negative territory for this long a period of time, we've had a recession follow soon thereafter. Now, the job market still seems to be too strong right now for that to happen, but we do know that the Fed's tightening policies tend to work with long lags. If you look at the yield curve, for example, and how long it's been inverted and compare that to prior cycles, we've still got some runway to go yet. So this kind of resiliency we're seeing is actually not that unusual. So if the banks are not lending, what are they focused on? Expense management for one thing. But as you can see from this chart, they have also been building up capital at a far greater pace than normal. As I mentioned, this is being driven by the fact that regulatory capital requirements are going up for the largest banks. The current estimate is 16% on average. So the banks are trying to get out in front of this, even though once the rule would be finalized, the new thresholds would be phased in over several years. So the banks are accomplishing this by retaining earnings, limiting share repurchases and other forms of payouts, and capping growth. And one would also think that this capital building phase would also have a bit of a cooling effect on the bank mergers and acquisitions market. And that's because not only would there be limited equity for such transactions, but the fact that many banks also still have large unrealized loss positions in their investment portfolios right now. And that too can work as a deterrent in terms of deal pricing. So in summary, during this pullback in lending, banks are focused on expense management, shoring up their liquidity and limiting capital payouts in anticipation of stricter capital rules to come. Thank you for your time. Have a good day, and give us a call or send us an email if you have any questions.